India's metal recycling sector faces a structural reckoning, driven by government mandates forcing a massive transfer of market share from informal scrap dealers to publicly listed entities. 1.68 lakh crore rupees. That is the projected valuation of this sector, expanding at a 5.2% compound annual growth rate through 2024 as capital aggressively reallocates across the industrial supply chain.
This report covers policy-driven formalization, supply chain vulnerabilities, margin expansion strategies of top-tier processors. Following this explainer, viewers will understand the operational metrics and sourcing bottlenecks dictating profitability for India's recycling industry.
Section 1. Policy-driven formalization. Let's dive right in. Historically, this market was basically unorganized, local scrap dealers running the show. Back in fiscal year 2016, informal players controlled a massive 80% of the market share. But look at today. That figure has shrunk to 60%. Organized, publicly listed companies are quickly absorbing this volume. And honestly, that shift forms the entire baseline investment thesis for the sector right now.
To understand the mechanics, you need to know that processing operations rely on two distinct streams. You've got primary sources, which involve the traditional, heavy-duty mining, extracting, and refining of raw ore. And then you have secondary sources, simply recovering and melting down existing scrap. Right now, the entire balance of global supply is tipping incredibly fast toward that secondary recovery.
Take lead, for example. Over 60% of the global lead supply is now derived from secondary recycling, not primary mining. Why? It's just highly favorable metallurgy. Lead retains its quality perfectly when melted down. Plus, 85% of the demand is concentrated in lead-acid batteries, which are incredibly easy to collect. To put that in perspective, in the US, 95% of all lead is already recycled.
So, what's driving this massive macro shift? Well, global ore grades are declining across the board. Domestically, India is staring down a structural deficit, currently importing over 50% of its copper and 60% of its aluminum. And then there's the massive energy payoff. Producing recycled aluminum uses 95% less energy compared to primary mining. Copper saves 85%, and recycling lead slashes CO2 emissions by up to a staggering 99%.
Because of these benefits, the government is aggressively accelerating this transition through regulation. Enter the Extended Producer Responsibility, or EPR framework. This essentially forces manufacturers to meet strict recycling quotas. Starting with aluminum, copper, and zinc in July 2025, the clock starts ticking. Producers have to hit a 10% recycling target by FY 2027, and that scales up ruthlessly to a 75% mandatory usage by FY 2033. To comply, these massive manufacturers literally have no choice but to partner with registered, formal recyclers.
And the government is sweetening the deal for the formal players with two major regulatory catalysts. First, the October 2024 GST reverse charge mechanism completely flipped tax liability to the buyer. This effectively wiped out the historical pricing advantage those informal scrap dealers used to enjoy. Second, the 2025 budget slashed basic customs duties to zero for lead, zinc, and 12 critical minerals. This gives the organized sector an absolute, distinct competitive edge. Institutional capital is reading the writing on the wall and aggressively funding this expansion. Look at the recent IPO demand. It's off the charts. Jain Resources Recycling, oversubscribed 15.9 times. CMR Green Technologies, an insane 89.11 times oversubscription rate. This capital isn't just sitting there, it's being deployed immediately. We're talking about firms like Gravita India executing a 1,200 to 1,500 crore rupee capital expenditure program straight through FY 2028.
Section 2. Supply chain vulnerabilities.
Now, if you break down the industry value chain, it happens in 4 stages: collection and sorting, pre-processing, processing, and finally sale or conversion. You might think the big money is in the processing technology, but profitability is actually dictated almost entirely by stage 1. Securing that raw scrap makes up 80 to 90% of a recycler's operational revenue. Without a rock-solid, consistent pipeline of raw material, operational margins simply collapse. And this exposes the sector's biggest Achilles heel, a severe domestic scrap deficit. Here's how it works. A country's current scrap supply is basically a mirror of its metal consumption from 10 to 20 years ago. Because India had historically low metal consumption 2 decades ago, the domestic scrap pool today is highly limited. That deficit forces India to be the world's second-largest metal scrap importer, trailing only behind China.
That import dependence imports a ton of volatility. Geopolitical risks are front and center. For instance, recent US-Iran conflicts and the closure of the Strait of Hormuz caused aluminum scrap prices to absolutely spike by roughly 30%. Plus, relying on imports forces companies to hold 45 to 90 days of inventory, which puts a massive strain on working capital. Just recently, elevated freight and fuel costs crushed Jain Resources' Q4 FY 2026 EBITDA margin down to a razor-thin 3.5%.
Processors know this is a huge vulnerability, so they're actively trying to build domestic sourcing resilience. Gravita, for example, pushed its domestic sourcing from 30% in FY 2024 up to 50% in FY 2026. But at the end of the day, operational realities often override long-term strategy. In Q3 FY 2026, Gravita actually dropped their domestic procurement back down to 25%. Why? Simply to capture the cost arbitrage when global import prices temporarily plummeted. So supply stability is in this constant tug-of-war with immediate margin optimization.
Which perfectly tees up Section 3, Margin Expansion Strategies. In this game, the ultimate metric is EBITDA per ton. Recyclers capture margin by buying scrap at a discount and selling the refined output at a premium. Copper is the heavyweight champion here, delivering the highest unit economics at over 30,000 rupees EBITDA per ton. That's driven by base prices that are 4 to 5 times higher than lead or aluminum, plus some really steep capital expenditure barriers that keep competitors out. Lead generally generates between 18,000 and 23,000 rupees, while aluminum yields anywhere from 10,000 to 20,000, depending heavily on the specific alloy.
But smart players find ways to beat those averages. Geographic sourcing arbitrage is generating some serious alpha right now. Take the lead market. While peers like Pondy Oxides and Jain Recycling pull in roughly 18,000 rupees per ton, Gravita is extracting 23,000. Their secret? They're tapping into informal African networks to source battery scrap at a massive 50 to 60% discount to London Metal Exchange prices.
Another brilliant strategy we're seeing is operational margin capture through co-location. CMR Green and Jain Recycling are literally building their aluminum processing facilities right next door to major automotive clusters in northern and western India. By doing this, they can deliver liquid, molten aluminum directly to the auto manufacturers. That completely eliminates the customer's need to remelt the metal, saving the automakers 2 to 3% in operating costs. The recyclers then capture a nice chunk of those savings as pure added margin.
Then there's forward integration, moving up the value chain into higher margin products. Capital is flooding into this space. Pondy Oxides is dropping 200 crore into a brand new copper cathode facility, hoping to launch their unit EBITDA from 35,000 up to 60,000 rupees per ton. Gravita is aggressively expanding into lead oxides and sheets, aiming for these value-added products to make up 50% of their total revenue by FY 2029. And Baheti Recycling? They're running the exact same playbook, pushing into the lucrative aluminum wire rod segment.
Looking slightly further ahead, the absolute frontier of margin expansion is critical minerals. Just on the horizon, in October 2025, the government is set to launch a 1,500 crore national critical mineral mission. This massive scheme is designed to directly incentivize companies like Gravita, Namo E-Waste, and Eco Recycling to build the complex infrastructure needed to recover high-value lithium, cobalt, and nickel from e-waste and depleted batteries. So, what does this all mean for the road ahead? The capital is definitely flowing and processing capacity is expanding rapidly. But fulfilling that FY 2033 mandate, the one requiring 75% domestically recycled metal usage, exposes the system's most glaring vulnerability. India is still critically dependent on imported scrap. Meeting those strict EPR deadlines dictates an immediate, end-to-end overhaul of the country's internal scrap collection infrastructure. The processing tech is capitalized and ready to go. Now the true test for this industry is whether it can secure the domestic supply chain before the clock runs out.